Hello, this is Raymond Shapiro, Portfolio Manager of the Merchant West SCI Dividend Equity Fund. This is the quarterly report for the period ending 30th September 2023. The fund produced a resilient performance over the quarter, gaining 0.1% and outperforming its benchmark, the South African General Equity Peer Group Average, which fell 2% over the period. The JSE Capped Swix Index fell 3.8% over the quarter, with the JSE All Share Index losing 3.5% over the period. The South African market's performance was dragged down by negative returns from resources, Naspers and Richemont, largely due to Chinese economic weakness and weakening global growth prospects. A positive contributor to returns were SA economy-centric equities, which rose during the quarter. The fund's returns over the period were driven by its SA Inc. equities exposure, which comprised 40% of the fund. The fund's direct offshore equities exposure detracted from returns, falling in both rands and US dollars. Market overview. Globally, the third quarter of 2023 started off on a positive note, as inflation data in the US for June came in lower than expected. This prompted optimism that the US Federal Reserve is nearing the end of its monetary tightening cycle, with investors choosing to focus on when interest rates may start falling, amid signs that inflation is waning. The optimism in financial markets was short-lived, however, as further signs of weakness in the Chinese economy began to surface. Furthermore, consumer confidence in the US began to decline after having reached a two-year high in July. However, hawkish comments from the US Fed sparked renewed fears of another interest rate hike in the US due to stubbornly high inflation. Investors now fear that interest rates may stay higher for longer. The situation was exacerbated by oil prices rising 25% over the period. US Treasury bond yields across the curve spiked sharply over the quarter, with the 10-year Treasury yield reaching a 15-year high of 4.75% at the end of September, rising almost 100 basis points over the period. While consumer prices in the Eurozone and the UK have begun to slow, inflation is still significantly higher than their respective central banks have targeted. Both the European Central Bank and the Bank of England raised rates during the third quarter, with the higher rates resulting in a continued slowdown in economic activity for both regions. The rally in global equity prices since October last year ended abruptly towards the end of July, with the MSCI World Index falling 3.4% in US dollars for the September quarter, while the MSCI Emerging Markets Index lost 2.8% in US dollars over the period, with China being the biggest drag. In South Africa, the SA Reserve Bank remains hawkish amidst a weakening rand and higher oil prices. Slower global growth, low commodity prices and a stagnant local economy, persistent load shedding and cash-strapped consumers struggling in the wake of higher interest rates have led to a depressed situation in South Africa. Government finances have become increasingly constrained amidst lower tax collections, especially from mining companies. Against this economic backdrop, and in sympathy with global markets, the JSE All Share Index declined 3.5% over the third quarter. Portfolio strategy. Despite the depressed situation in the South African economy, SA Inc. equities as a group managed to outperform global stocks and post a positive return over the period. We believe this is a result of the attractive value being offered by this grouping, which is slowly being recognized. As such, we still retain a significant weight in SA Inc. equities, as despite risks, a number of these stocks present attractive absolute and relative value, with much bad news priced in. Nonetheless, we are still cautious about the risks attached to the local economy. Additionally, weakening global and China growth prospects are weighing heavily on metals prices, which affect the SA fiscal situation and flow through to the local economy. As such, we maintain a significant underweight in resources stocks. Importantly, we believe owning significant weights in both resource counters and SA Inc. equities to be poor risk management in the current environment. Instead, in addition to owning SA Inc. equities, we favor a position in defensive skewed global dividend equities, as well as holding select non-resource rand hedge stocks. The relative attractiveness of SA dividend-paying companies we believe is still highly underappreciated by investors. However, with the fund being able to invest up to 45% in direct offshore equities, we continually scan the globe for the best dividend-paying opportunities available. We estimate the net 12-month forward distribution yield based on consensus forecasts on the fund to be well over 4% at present.